What's going on, future millionaires? Why did the prices of goods and services increase with time? A dollar back in the 1950s could buy you more than what you could buy with $10 today. But why is that so? This is where the understanding of inflation is necessary to manage your finances and use your money proficiently. But what does inflation really do, and why do people keep debating about it in headlines? Whether inflation is better for you or not, and how you can protect yourself from inflation that reduces your purchasing power. You're going to know everything about inflation today so that you can effectively manage your finances better than the rest of the people. Let's get started with what is inflation in the first place. Inflation, in simple words, means the decline of purchasing power of any currency over time. If you ask your grandpa the value of a dollar back in his childhood days, he would tell you how much money a mere $1 was. With the passage of time, every currency loses its value, which is called inflation. In another sense, inflation can be defined as the increase in the prices of goods and services. Whether the purchasing power of currency is dropping or the prices of goods are increasing, you have to pay more to buy the same. To have a feel of what inflation really is, you can compare the prices of a basket of selected goods and services over 2 or more different periods. Any rise in the general level of prices means that your currency buys less than it could in prior periods. This whole process where your currency buys you less than what it could buy you in the past is called inflation. But what happens when there is inflation? Since money loses its value and purchasing powers, prices of goods and services rise. You could buy, let's say, a cake for $5 in the past, and today it costs you $10. Given the condition that your income is the same as before, your purchasing power has decreased by half. Therefore, the loss of purchasing power impacts the general cost of living and ultimately leads to a deceleration in economic growth. People have to pay more to get the same, which disturbs their budget. The consensus among economists is that sustained inflation occurs when a country's money supply growth outpaces its economic growth. Now here lies something interesting. Even though there is more money to spend, the quantity of the goods is the same. This means more money is able to buy that same quantity of goods. Only the amount of money has increased, pushing the prices of goods higher. But what actually causes inflation? The increase in the money supply is the biggest root of inflation. What it really means is a country prints more money than its economic growth. On the other hand, the country is producing the same amount of goods. To bring that extra amount of printed money into circulation, the government increases the prices of goods so that people can legally use that money to buy those products. On the other hand, people are provided with more money so that their purchasing power can be on the same level. The money earned in taxes also increases the support to a country's economy. This might seem simple, but there are several complex steps behind how inflation works for the government. There are 3 different mechanisms that bear inflation in the market. The first one is demand pull inflation. There is a law in economics: when the demand for goods increases, their price also increases. Demand pull inflation occurs when an increase in the money supply stimulates the economy's demand more rapidly than the economy's production capacity. This means that a country is producing little, but the demand is high, which pushes the prices of those goods. This increase in demand leads to a rise in price. People are ready to pay more for the same product since there is a shortage in the market. They have more money to pay, so why not pay more? Since there is more money in the economy, people tend to have a more positive outlook on life and enjoy spending money more often. Since the demand is more than the supply, the demand pulls the price up to match supply and demand. The second is something called cost push inflation. Cost push inflation occurs when the prices of raw materials increase. In other words, if the prices of inputs to produce a product increase, the sale price of that finished good will also increase. There can be a time when during the production of a product, the prices of raw materials increase. Since the pieces that go into the final product are getting more expensive, the final product will increase in the sale price as well. This increased cost of intermediate parts pushes the overall cost of the final product up, or the wages of labor can also increase, which will have a direct effect on the sale price of a particular product. And the third type of inflation is called built-in inflation. Built-in inflation is inflation caused by people's expectation about the market. This is the idea that people expect current inflation rates to continue in the future. As the prices of goods are increasing, people think that the prices will continue to rise at a similar rate. When there is a market sentiment that they will face inflation, they demand higher salaries and wages. Due to this reason, the cost of producing a product increases, and it eventually increases the price of the product. In simple words, people themselves made the price rise by demanding higher salary. Here's a little fun fact. It is common to expect a 3% annual raise in salaries almost anywhere you work. Inflation rates stay around 3% on average every year. So just because you got a 3% raise in salary that looks bigger on paper, You feel your salary has increased, but in reality, you can still only purchase exactly what you were purchasing earlier, since the prices of goods have also increased by 3%. And what you guys have all been waiting for, here comes how to protect yourself against inflation. Even if you know what inflation is, it's of no use if you don't know how you can protect yourself from it. If you love to keep the money as cash and put it under your mattress, you are the one who will be facing the worst effects of inflation. As you already know, the currency is losing its value every minute, therefore keeping cash won't be a good idea. The remedy is to put your money in something that increases its price with time, the same way as inflation does. In this way, on one side, the prices of goods will be increasing, while on the other side, your money as assets will also grow. Hence, the inflation effect will be canceled by the increasing returns of your money. Stocks are commonly considered the best hedge against inflation because the rise in stock prices is inclusive of the effects of inflation. There are also special financial instruments that safeguard your investment against inflation. They include Treasury Inflation Protected Securities, or TIPS, which is low-risk treasury security that is indexed to inflation where the principal amount invested is increased by the percent of inflation. There are also TIPS mutual funds as well as TIPS exchange traded funds. They all work by canceling the effect of inflation by offering you returns approximately equal to the inflation rate. If you want a simple solution, then you can buy gold or invest in it. Gold has always been used as a hedge against inflation. Real estate is also a great investment to hedge against inflation, which is my favorite option. And here is another way to nullify inflation that's kind of fun. You can buy products a year before they are actually used. You need to choose those particular products that don't expire within a year. How it works is interesting to know. It is common that the inflation rate is about 3% a year, so if you buy something today and you use it a year later, you will be saving 3%. Everyone would pay 3% more, however, you would have bought it at a price 3% lower. This is not a phenomenal remedy, but it is worth a try to at least save some of your money, and it's kind of cool to think about. You can enforce it by buying products using coupons or during sales, and that way you can get an additional discount of 20 to 50%. In total, you can get returns of 23 to 53% if you buy products today rather than a year from now. So, did you know you could protect yourself from inflation by just buying products a year before they are used? Protect yourself from inflation by following these simple steps to increase your purchasing power. Don't be shy to comment right below what will you suggest to avoid inflation. Also, make sure to subscribe to our channel and press the bell icon right next to it to get your weekly dose of all things finance. Until the next video, stay tuned.